Welcome to the Deep Dive. Today, we're tackling a subject that, well, it underpins so much of the business world, lease accounting.
It really does.
You, our listener, have steered us towards a really interesting comparison, looking at how leases are treated under IFRS, that's International Financial Reporting Standards, and US GAAP, the United States Generally Accepted Accounting Principles.
Yeah, two major frameworks.
So, our mission today, to unpack the crucial similarities and maybe more importantly, the key differences, give you a clear picture of what's going on with lease accounting.
Exactly. We'll be digging into the material you shared, specifically looking at IFRS 16 and Topic 842 under US GAAP.
Topic 842, right? The lease part of GAAP.
That's the one. We're going to look at how each framework defines a lease, how they classify them, measure the financial impact, and, how modifications are handled, both for the lessee.
The one using the asset.
Right, and the lessor, the one providing it.
And for you, the learner, our goal here is to take this, let's face it, potentially complex area and give you a clear, structured understanding.
Cut through the noise a bit.
We're really going to zero in on those critical distinctions, the principles behind them, hopefully give you some of those satisfying aha moments without getting bogged down in jargon.
Yeah, make it make sense.
Okay, let's dive in. First things first. What is a lease according to these standards, fundamentally?
Well, at its core, IFRS and US GAAP actually agree. They both say a lease is a contract, or part of one, that gives someone the right to control the use of a specific identified asset for a period of time.
In exchange for payment, presumably?
In exchange for consideration, yes. Payment.
Okay, identified asset. Does that mean it needs like a specific serial number? What makes it identified?
Good question. It doesn't always need a serial number, but it needs to be specific. Both frameworks look for similar things.
Like what?
Well, the asset needs to be either physically distinct, that specific machine, or it has to represent substantially all the capacity of a larger asset. Think leasing almost an entire floor of a building. It also has to be explicitly spelled out in the contract, or at least implicitly specified. And importantly, the supplier, the lessor, can't have a real practical right to just swap it out for another asset whenever they want.
So no substantive substitution rights.
Exactly. And these criteria, pretty much identical under both IFRS and US GAAP. The key idea is that the lessee gets specific use of a defined asset.
Got it. Now, what about this idea of control? That sounds like more than just having the keys, right?
Oh, absolutely. Control, again, is seen similarly by both. It means the lessee has the right to get, substantially all the economic benefits from using that asset.
Benefits like?
Could be income it generates, cost savings, other advantages. And crucially, control also means having the power to direct how and for what purpose that identified asset is used.
Okay, directing its use. The sources mentioned pipelines or cables underground. How do those fit in? It seems less tangible.
That's a great practical example. Both IFRS and GAAP would generally view putting infrastructure like that in specific underground space as a lease if certain conditions are met.
Such as?
Such as the space being physically distinct, the operator having exclusive use of it, the purpose being set out in the agreement, and the operator controlling it through things like maintenance.
So exclusivity and operational control. Makes sense. Now, what about intangible assets? Patents, software licenses, that sort of thing.
Here's our first significant divergence. IFRS generally covers leases of property, plant, equipment, and other assets, but it has a few specific exclusions, like minerals, some biological assets.
Right.
But interestingly, IFRS actually allows companies to choose to apply the lease standard to other intangible assets if they want.
Oh, really? An option?
Yeah. US GAAP, though, draws a harder line. It explicitly excludes all leases of intangible assets right from the start. No option.
Wow. Okay. That's a big difference in scope right there.
Yeah.
What about those shared exclusions you mentioned, besides minerals?
Right. So both IFRS and US GAAP kick out leases for exploring or using non-renewable resources, oil, gas, that kind of thing. And biological assets held by the lessee are out for both, too. Though there's a little wrinkle, US GAAP specifically includes leases of timber, whereas IFRS considers timber a biological asset and excludes it.
Interesting nuance. Any others excluded by both?
Yes, service concession arrangements are out under both frameworks as well.
And are there exclusions unique to just one? You mentioned intangibles for GAAP.
Yes, US GAAP has a couple more specific ones. It excludes leases of inventory.
Inventory, okay.
And also leases of assets that are still under construction but only if the lessee doesn't actually control the asset before the lease officially starts. IFRS doesn't have those specific exclusions.
Right, so the boundaries are definitely drawn a bit differently. Let's shift gears. Contracts often bundle things together, the lease itself, plus maybe maintenance or other services. How do they handle separating those lease and non-lease components?
The basic principle is the same for both. You need to account for the lease part separately from the non-lease part.
And how do you split the payment?
It's based on the relative standalone prices of each component. So you'd look at what the lease part would cost on its own and what the service part would cost on its own and allocate the total payment based on that ratio.
Okay, like figuring out the price of the printer lease versus the price of the separate maintenance contract.
Exactly like that. But both frameworks offer a practical shortcut for lessees.
Oh, a simplification.
Yes. Lessees can choose as an accounting policy by class of underlying asset, like for all their office equipment or all their vehicles, to just not separate them. They can treat the lease and non-lease parts as a single lease component.
That could make life easier. Does the lessor get that same choice?
No, lessors have to separate, always.
Yeah.
Under both IFRS and US GAAP, lessors must allocate the contract price based on standalone selling prices, following the guidance in the revenue recognition standard.
Got it. Lessor's always separate. What about variable payments, ones that aren't fixed? How are those allocated?
For lessors, variable consideration is handled using the revenue standard. It might get allocated entirely to one component if certain criteria are met.
Okay. And for lessees?
For lessees, US GAAP says they allocate variable payments based on those relative standalone prices we talked about. IFRS doesn't explicitly tell lessees how to do it, but it's generally seen as acceptable for them to apply similar logic using the revenue standard principles.
Now, the sources mentioned a couple of US GAAP-specific things here. A residual approach for lessees and a single component election for lessors. Can you unpack those?
Sure. US GAAP explicitly allows lessees, under certain conditions, to use a residual approach to estimate a standalone price if it's highly variable or uncertain. Basically, you figure out the prices you do know, and the leftover amount is assigned to the uncertain item. IFRS doesn't forbid this, but it's explicitly mentioned in US GAAP. For lessors, US GAAP has this unique single component election. They can choose not to separate if the non-lease part would fall under the revenue rules, if its timing and pattern match the lease component, and if separating them would result in an operating lease classification.
That's specific.
It is. And if they make that election, how they account for the combined component depends on whether the non-lease part is predominant. If it is, it's accounted for under revenue rules. If not, it's treated as a single lease component, definitely a US GAAP-only feature.
Okay, let's move on to the lease term. How long does the lease actually last for accounting purposes?
The core definition is very similar under both IFRS and GAAP. It starts with the non-cancelable period.
Makes sense.
Then you add any periods covered by an option to extend the lease if the lessee is reasonably certain they'll exercise that option.
Reasonably certain.
And you also include periods after a potential termination date if the lessee is reasonably certain not to terminate. So it's about the legally enforceable period plus the economically likely period.
So that reasonably certain part seems key. It's not just the dates written in the contract.
Exactly. You have to look at all the relevant facts and circumstances that create an economic incentive for the lessee to renew or not to terminate.
Like what kind of things?
Big one is significant leasehold improvements the lessee made that they can't remove and that would still have value if they stayed. Cost of moving, availability of alternatives, lots of factors. And this assessment is the same under both frameworks.
What if it's the lessor who has the option to terminate unilaterally?
Good point. Under both IFRS and US GAAP, the lease term includes any period where only the lessor has the right to terminate.
And when is the lease considered completely over?
The lease term ends when a point is reached where both the lessee and the lessor can choose to terminate the lease without needing the other party's permission and without facing more than an insignificant penalty.
And insignificant penalty looks at the bigger economic picture.
Yes, it considers the broader economics, not just a small stated fee. Again, consistency between IFRS and GAAP here.
Okay, let's talk money. Lease payments. What gets included when calculating the lease liability and asset?
For both the lessee and the lessor, it starts with fixed payments. That includes payments that might look variable, but are, in substance, fixed, less any lease incentives received, of course.
Right.
Then you add variable payments that are based on an index or a rate CPI adjustments or payments tied to LIBOR or whatever the current benchmark is.
Okay, index or rate-based.
Also, if there's a purchase option at the end and the lessee is reasonably certain to exercise it, the exercise price is included.
Makes sense.
And finally, any penalties for terminating the lease early are included if the lease term itself reflects the expectation that the lessee will terminate early.
So it's all payments directly tied to getting that right to use the asset for the determined term. What's excluded from that initial calculation?
Variable payments that depend on the use or performance of the underlying asset are generally excluded from the initial measurement.
Like payments per mile driven or per unit produced.
Exactly. Those are typically just expensed in the period they occur under both IFRS and US GAAP.
Got it. What about residual value guarantees, where the lessee guarantees the asset's value at the end?
Right. Those are included in lease payments for the lessee under both frameworks. US GAAP clarifies it's the amount probable of being owed under the guarantee.
Okay. And for the lessor, how do they treat those guarantees?
IFRS includes residual value guarantees from the lessee or related parties in the lessor's lease payments. US GAAP, interestingly, excludes them from the definition of lease payments for the lessor, but it includes them in the measurement of the lessor's net investment in the lease for finance, sales type, and direct financing leases. So while the definition differs, the impact on the lessor's receivable amount is often quite similar in the end.
Subtle difference in definition, similar outcome. Okay, let's tackle taxes. Always a fun one. Property taxes, sales taxes. How do they fit into lease accounting?
Yeah, this is an area with some notable differences. Under IFRS, the approach for property taxes really hinges on who is the statutory obligor who the law says has to pay the tax.
Okay, legal responsibility.
If the lessor is legally obligated, it's a cost for them, a levy. If the lessee reimburses the lessor, that reimbursement becomes part of the lease payments, could be fixed or variable. If the lessee is legally obligated, it's a cost for them, treated as a levy.
And VAT or sales tax under IFRS.
For things like VAT, if the lessor collects it from the lessee, just acting as an agent for the government, it's not a lease payment. But if the VAT is legally on the lessor and the lessee pays it, then it is a lease payment. No practical expedient or simplification is offered.
So IFRS is very focused on the legal obligation.
Yeah.
How does US GAAP handle property and sales taxes?
US GAAP looks at it a bit differently. For lessees, accounting for property sales taxes depends on who's primarily obligated and when the tax is incurred. If the lessor is the primary obligor, the taxes might be part of the initial lease payments or treated as variable payments over the term. If the lessee is the primary obligor, it's generally outside the scope of lease accounting altogether.
And no equivalent levy concept like in IFRS.
Right, which can lead to different results. For lessors dealing with sale-similar taxes, US GAAP gives them an option, a practical expedient to present amounts collected from lessees on a net basis, meaning excluded from revenue.
An election.
Yes. If they don't elect that, the accounting then depends on who actually remits the tax to the government. If the lessee remits, it's net presentation for the lessor. If the lessor remits, it's gross presentation. And how it's accounted for depends on the lease classification, operating, sales type, etc. More complex. Definitely.
It seems like it. US GAAP also mentioned payments to special purpose entities.
Yes, US GAAP explicitly includes payments made by a lessee to the owners of an SPE related to structuring the lease transaction within the definition of lease payments. IFRS doesn't specifically address this.
Okay, let's talk discount rates. The rate used to calculate the present value. What's the main approach?
Both frameworks prioritize using the interest rate implicit in the lease if it can be readily determined.
And how is that defined?
It's the rate that makes the present value of the lease payments plus any unguaranteed residual value equal the fair value of the underlying asset plus. And here's a subtle difference.
Oh.
IFRS includes all initial direct costs incurred by the lessor in this calculation. US GAAP only includes the deferred initial direct costs of the lessor.
Does that difference matter much in practice?
Ultimately, no, because the overall accounting for those costs ends up consistent, as we'll see, but the definition is slightly different. Also, US GAAP explicitly prohibits using a negative implicit rate, whereas IFRS is silent on that.
Okay, and what if that implicit rate isn't readily determinable?
Well,
which is probably common.
Then the lessee uses their incremental borrowing rate, IBR.
Which is?
It's the rate the lessee would have to pay to borrow funds over a similar term with similar security to obtain an asset of similar value in a similar economic environment. basically what it would cost them to borrow for that specific asset.
And can they adjust that rate?
Yes, both frameworks say it's appropriate, IFRS, or should be made, US GAAP, to adjust the IBR if the payment profile of the theoretical loan differs from the lease payment profile.
Now, US GAAP has something special for private companies here.
It does. Private company lessees under US GAAP get an option. If the implicit rate isn't readily determinable, they can elect, by class of underlying asset, to use a risk-free discount rate for a comparable term instead of estimating their IBR.
Ah, simplification for private companies. IFRS doesn't have that.
No, that's a US GAAP-specific practical expedient for private entities.
Got it. What about initial direct costs? What counts?
They're defined very similarly. Incremental costs of obtaining a lease that wouldn't have been incurred if the lease hadn't been obtained.
Like commissions.
Exactly. Commissions, payments to existing tenants to get them to vacate those, are included under both.
And what's included?
Things like general overhead allocations, internal legal costs that weren't contingent on signing this specific lease, those are out for both.
Is there any difference in scope?
Minor ones. IFRS excludes costs incurred by manufacturer-dealer lessors related to finance leases. US GAAP excludes costs for sales-type leases that result in manufacturer-dealer profit or loss. Generally, though, the scope is very similar.
Okay, let's switch back to the lessor side. Lease classification. Big difference here, right?
Yes.
IFRS has 2 types, US GAAP has 3.
That's right. IFRS keeps it to 2. Operating or finance. The decision hinges on whether the lease transfers substantially all the risks and rewards of ownership.
Simple enough.
And US GAAP.
US GAAP has operating, sales type, and direct financing.
Okay, break those down. A sales-type lease under US GAAP essentially means control of the asset has effectively transferred to the lessee. A direct financing lease means substantially all risks and rewards have transferred, like an IFRS finance lease, but control hasn't. If neither of those apply, it's an operating lease.
So, sales type and direct financing in US GAAP roughly equate to a finance lease in IFRS.
Generally, yes. US GAAP just splits that finance category based on whether control is deemed to transfer.
And when does the lessor make this classification decision?
Another difference. IFRS classifies at lease inception when the agreement is made or parties commit.
Okay.
US GAAP classifies at lease commencement when the asset is actually made available for the lessee to use.
And can that classification change later?
Under IFRS, it's only reassessed if there's a lease modification that isn't accounted for as a separate new lease.
And US GAAP?
US GAAP reassesses upon such modifications too, but also if a lessee exercises an option, like renewal or purchase, that was previously deemed not reasonably certain to be exercised. So US GAAP has more potential triggers for reassessment.
More triggers, okay. IFRS mentions specific guidance for manufacturer-dealer lessors. Does GAAP have an equivalent category?
Not a single broad category with that name, no. But US GAAP does have specific accounting for lessors when a sales-type lease results in a manufacturer or dealer profit or loss. So it addresses the scenario, just not with a distinct category label like IFRS.
Let's dig into the criteria for deciding between finance, sales type, and operating. IFRS uses indicators. US GAAP uses tests.
Exactly, and that's a fundamental difference in approach. IFRS provides indicators situations that suggest it's probably a finance lease.
Such as?
Transfer of ownership at the end, a purchase option the lessee is likely to take, lease term covering the major part of the asset's economic life, present value of payments being substantially all of the asset's fair value, or the asset being highly specialized.
But these are just indicators, not hard rules.
Correct. They're signals. The ultimate decision under IFRS is a judgment call. Have substantially all the risks and rewards shifted. IFRS doesn't even define major part or substantially all with bright lines, although it acknowledges the US GAAP thresholds can be reference points.
And US GAP's approach.
US GAAP turns these into pass-fail tests or criteria. If any one of the 5 main criteria is met, transfer ownership, written purchase option, reasonably certain, term is major part of life, PV of payments plus guarantee is substantially all of fair value, specialized asset, then it's generally classified as sales type or potentially direct financing. It's much more determinative.
And US GAAP does offer those quantitative bright lines.
Yes, the 75% for major part and 90% for substantially all are mentioned as optional but commonly used bright line thresholds in US GAAP practice guides.
Does IFRS have any other indicators besides those main 5?
Yes, it mentions others, like if the lessee bears losses from cancellation, if the lessee gets the benefit or penalty from residual value fluctuations, or if there's a bargain renewal option.
So overall, IFRS is more principles-based, judgment-heavy, while US GAAP is more rules-based here.
That's a fair summary of the classification approach.
What happens under US GAAP if none of those 5 sales type criteria are met?
Then it might be a direct financing lease. That happens if it doesn't meet the sales type tests. But the present value of the payments plus any lessee residual guarantee does meet the substantially all fair value test, and collection of those payments is probable.
And if neither sales type nor direct financing criteria are met?
Then it defaults to an operating lease under US GAAP.
What if a lease would result in a loss at the start if classified as sales type or direct financing, maybe due to lots of variable payments?
US GAAP has a specific rule for that.
Yeah.
Such leases must be classified as operating leases. This generally aligns with the likely outcome under IFRS principles, too.
Okay, let's talk land and buildings. How are leases involving land handled?
Both frameworks apply their general classification indicators or tests. A key factor is that land typically has an indefinite economic life. So under IFRS, the focus remains on the overall transfer of risks and rewards. Under US GAAP, the fact land life is indefinite often means the lease term covers major part of economic life test isn't met, pushing the classification towards other criteria.
And if a lease bundles land in a building?
IFRS generally requires assessing the land and building components separately, unless the land value is clearly immaterial, or they'd obviously both fall into the same classification anyway.
The US GAAP?
Similar idea. US GAAP treats land as a separate component unless its accounting effect would be insignificant, so both tend towards separation.
Okay, separating land and building. Now, let's revisit the accounting for manufacturer or dealer lessors. What does IFRS say for a finance lease?
Under IFRS, the manufacturer-dealer lessor de-recognizes the asset they leased out. They recognize a finance lease receivable, that's their net investment. They recognize selling profit based on their normal sales policy, and then finance income over the lease term.
What about costs?
Costs of negotiating and arranging the lease are expensed when the selling profit is recognized, and the sales revenue recorded is the lower of the asset's fair value or the present value of the lease payments, using a market rate if the lease rate is artificially low.
And how does US GAAP handle a sales-type lease by a manufacturer dealer?
Similar starting point. De-recognize the asset, recognize the net investment. They recognize selling profit too, but only if collectability of the payments is probable right at commencement.
Ah, that probability check again?
Yes. Selling revenue is calculated similarly lower a fair value or the sum of the lease receivable, discounted at the implicit rate, and any payments received up front. Initial direct costs are expensed if fair value differs from carrying amount, otherwise they're deferred. And unlike IFRS, there's no specific adjustment if the interest rate is below market.
Okay, differences in collectability assessment and initial direct cost treatment there. What about other finance leases under IFRS, not manufacturer dealers?
For those, the lessor also de-recognizes the asset, recognizes the finance lease receivable, net investment. Initial direct costs get included in calculating that net investment, potentially creating a small gain or loss at commencement. Then, finance income over the term.
And the US GAAP equivalent, the direct financing lease, how's that accounted for?
Again, de-recognize the asset, recognize the net investment. Initial direct costs are included in the net investment, similar to IFRS, but any selling profit at commencement is deferred and recognized over the lease term, unlike the immediate recognition in a sales-type lease. Any loss is recognized immediately. Then, interest income over the term.
So the big difference for US GAAP direct financing is deferring that initial profit.
Exactly. That's a key distinction from a sales-type lease under GAAP, from how IFRS handles non-manufacturer finance leases if there happens to be a gain.
Right. Now let's cover operating leases for the lessor. How do they work?
Much simpler and very similar between IFRS and US GAAP. The lessor keeps the asset on their books.
Okay, it stays on their balance sheet.
Yes. And they recognize lease income, usually on a straight-line basis over the lease term, unless another systematic basis better reflects the pattern of benefit the lessee gets. Any lease incentives given reduce the income recognized over the term.
Any differences at all?
A small one in initial direct costs. IFRS adds them to the carrying amount of the leased asset and expenses them on the same basis as the income, for example, straight line.
Okay.
US GAAP requires deferring those initial direct costs as a separate asset and amortizing them over the lease term, usually straight line. Also, US GAAP has that specific guidance about potential collectability issues, possibly leading to recognizing income only on a cash basis.
That cash basis trigger again. Okay, let's flip entirely now. Lessee accounting. The big picture. IFRS has one model, GAAP has two.
That's the headline, yes. IFRS basically uses a single on-balance sheet model for almost all leases from the lessee's perspective.
Mhm.
They recognize a right of use, RU asset, and a lease liability unless an exemption applies.
One main approach
Yeah.
in US GAAP.
US GAAP uses a dual model. Lessees classify leases as either finance or operating, using criteria very similar to the lessor's sales type tests.
Okay.
Both finance and operating leases under US GAAP result in an ROU asset and a lease liability being recognized initially on the balance sheet.
So leases come onto the balance sheet under both models in GAAP too.
Yes, that's a key convergence point. But the subsequent accounting, how those assets and liabilities are measured and how the expense hits the income statement differs significantly between a US GAAP finance lease and a US GAAP operating lease.
So the initial recognition is similar, but the follow-on accounting diverges within GAAP itself.
Precisely. That's the essence of the dual model.
What about those exemptions you mentioned? Can lessees avoid putting leases on the balance sheet sometimes?
Yes, both frameworks offer an exemption for short-term leases, those with a lease term of 12 months or less at commencement.
And that's an election.
Yes, it's an accounting policy choice made by class of underlying asset under both IFRS and GAAP. So you could apply it to all your short-term office equipment leases, for example.
Any differences in the short-term definition?
Minor one. Under IFRS, a lease with a purchase option can never be short-term. Under US GAAP, it can still qualify if the lessee is not reasonably certain to exercise that purchase option.
Okay. Any other exemptions?
IFRS has one more. An exemption for leases of low-value assets, assessed when the asset is new. This is judged on an absolute basis. For example, under $5,000 was the illustrative example, though no hard limit is set, and can be applied lease by lease even if the total is material.
Low value, like tablets or small office furniture.
Exactly, but it doesn't apply if the asset is highly dependent on other leased assets or if it's being subleased. US GAAP does not have an equivalent low-value asset exemption.
No low-value break under GAAP. If a lessee uses these exemptions, how's the expense recognized?
Simple rent expense. Under IFRS, it's straight line or another systematic basis reflecting the benefit pattern. US GAAP requires straight line only.
And if a short-term lease gets extended beyond 12 months?
Both treat it as a new lease at that point. US GAAP also has a specific rule if a longer lease term is later reduced to 12 months or less.
Okay, so for leases that do go on the balance sheet, how does the lessee initially measure the liability and the asset?
The initial measurement is very similar. The lease liability is the present value of the future lease payments, discounted using the implicit rate, if known, or the lessee's incremental borrowing rate.
Okay, PV of payments.
The ROU asset starts at the same amount as the initial liability, plus any initial direct costs incurred by the lessee, plus any payments made at or before commencement, minus any lease incentives received, plus an estimate of future dismantling and restoration costs.
Restoration costs included too.
Yes, under both. US GAAP doesn't have the IFRS exception where restoration costs related to producing inventory follow inventory accounting, but otherwise, initial measurement is quite aligned.
So initial recognition is similar. Where do the big differences come in the subsequent accounting for lessees? Back to that single versus dual model.
Exactly. Under IFRS's single model, it's straightforward. The lease liability is accounted for using the amortized cost method, like a loan recognizing interest expense.
Okay.
The ROU asset is generally treated like owned property, plant, and equipment depreciated, usually straight line, over the shorter of its useful life or the lease term, and tested for impairment.
So interest expense on the liability, depreciation expense on the asset.
Correct. That's the IFRS approach for essentially all non-exempt leases.
Now, US GAAP's dual model. How does that work after initial recognition?
Okay, so under US GAAP, remember we have finance leases and operating leases on the balance sheet.
Right.
For a finance lease, the subsequent accounting is very similar to IFRS. You have interest expense on the liability, amortized cost, and amortization expense on the ROU asset. The expense pattern is front-loaded, higher in early years.
Okay. Finance lease under GAAP looks like IFRS.
Yeah.
What about an operating lease under GAAP?
This is where it differs significantly. For an operating lease, the goal under US GAAP is to achieve a single straight-line total lease expense in the income statement over the lease term.
One single expense line, combining interest and amortization somehow.
Sort of. The lease liability is still reduced over time, but the ROU asset amortization becomes the plug figure needed to make the total expense, interest on the liability plus ROU amortization, equal that straight line amount.
Huh. So the ROU asset amortization isn't necessarily straight line itself.
Correct. It's whatever number makes the total expense straight line. This means the expense recognition pattern for a US GAAP operating lease is level over time, unlike the front-loaded pattern of a finance lease or an IFRS lease.
That's a major difference in the P&L presentation and pattern.
Absolutely. Same assets, same payments, but different expense profile depending on US GAAP classification.
What about remeasuring the liability if things change, like an index rate goes up?
Under IFRS, the liability, and usually the ROU asset, is remeasured for various changes. Changes in expected residual value guarantees, changes in indices or rates affecting payments, lease term changes, purchase option reassessments, etc., using updated discount rates in many cases.
And US GAAP.
For finance leases, it's similar, except US GAAP generally doesn't remeasure just for changes in an index or rate unless the liability is being remeasured for another reason, like a term change. Those index rate changes usually just flow through expense as incurred.
Okay, after US GAAP operating leases.
The liability is remeasured for changes like lease term reassessments using an updated discount rate. The ROU asset is adjusted accordingly, often maintaining that single lease cost profile.
Got it. Depreciation, amortization, and impairment. Anything more to add there?
Just to reinforce, IFRS depreciates the ROU asset like owned PP&E. US GAAP amortizes finance lease ROU assets similarly. But for US GAAP operating leases, the ROU asset amortization is that calculated plug figure to get the straight line total expense.
And impairment testing.
Both apply their respective impairment standards, ISS 36 for IFRS, ASC 360 for US GAAP to the ROU assets. And both require accelerated amortization depreciation if there's a plan to abandon the asset early.
Okay. Lease modifications. Yeah. Contracts change. How are modifications handled?
Both define it similarly, a change in scope or consideration not in the original terms.
Right.
Both also had temporary relief measures for COVID-19 rent concessions, though the exact conditions and timeframes differed slightly. US GAAP's relief was perhaps a bit broader.
How do they decide if a modification is a separate new lease versus just adjusting the old one?
The test is the same for both lessors and lessees under both frameworks. It's treated as a separate lease if the modification adds a distinct right of use, increases scope, and the price for that increase is commensurate with its standalone price.
Okay, additional scope for additional fair payment new lease. What if it's not a separate lease? How does the lessor act up for it?
It gets complicated and depends on the original and modified classification. For example, under IFRS, if an original finance lease is modified such that it would now be operating, the old lease is effectively terminated and a new operating lease starts. US GAAP has similar but more detailed rules depending on whether it was originally sales type or direct financing and what it becomes, operating sales type or direct financing.
And if an operating lease is modified and not treated as separate,
Both generally treat it prospectively from the modification date, adjusting for prior payment SAC rules. US GAAP's separate contract guidance might also apply here, which is a nuance.
what about the lessee accounting for modifications not treated as separate leases?
Both generally remeasure the lease liability using a discount rate determined at the modification date.
Okay.
If the modification decreases the scope, for example, giving back floor space, both frameworks reduce the ROU asset and recognize a gain or loss on the portion derecognized.
But what if it just changes payments or term without reducing scope?
Then the adjustment typically goes against the ROU asset value, usually without immediate P&L impact unless the ROU asset hits zero.
Any key differences in lessee modification accounting?
Yes, a couple of big ones. US GAAP requires the lessee to reassess the lease classification, finance versus operating, at the modification date. IFRS generally doesn't. Also, US GAAP specifically states that just reducing the lease term is not treated as a decrease in scope triggering gain-loss recognition, unlike IFRS potentially. US GAAP also has specific rules if an original finance lease becomes an operating lease post-modification.
Wow, okay. Modification accounting seems like a minefield of differences. Let's move to sale and leasebacks. Company sells an asset and immediately leases it back.
Right. First step under both is determining if a sale actually occurred, using the principles from the revenue recognition standards, IFRS 15 ASC 606.
What might prevent it from being a sale?
A big one is if the seller lessee has a substantive option to repurchase the asset. IFRS generally says that prevents sale treatment. US GAAP is similar, but for assets other than real estate, it might still be a sale if the repurchase is at fair value and similar assets are readily available.
Another nuance. What if the leaseback part is classified as a finance, IFRS, or sales type, US GAAP lease?
Here's a key difference. Under IFRS, a finance leaseback does not automatically prevent sale accounting. Under US GAAP, a leaseback classified as anything other than operating, i.e. sales type or direct financing from the lessor's view, automatically prevents sale accounting for the seller lessee.
So US GAAP is stricter. The finance sales type leaseback means no sale occurred.
Correct. If no sale occurred, both treat it as a financing arrangement, though the specific accounting under IFRS 9 versus US GAAP financial instrument rules will differ.
If a sale is deemed to have occurred, how does the accounting work?
The buyer-lessor applies regular lessor accounting. The seller-lessee applies lessee accounting. But how the seller-lessee measures their ROU asset and recognizes gain-loss differs. IFRS measures the ROU asset based on the proportion of the previous carrying amount retained and recognizes gain-loss only on the rights actually transferred to the buyer-lessor.
Okay.
US GAAP measures the ROU asset based on the present value of the lease payments, and the gain or loss recognized is the full difference between the sale proceeds and the asset's entire previous carrying amount, adjusted for any off-market terms.
So different ROU measurement and potentially different gain-loss recognition. Both adjust for off-market terms.
Yes, if the sale price or lease payments aren't at fair value, both require adjustments to reflect the substance of the transaction.
What if the lessee controlled the asset before the lease even started? Maybe they built it.
Both frameworks agree that if the lessee controlled the asset before transferring it to the lessor, even if construction just finished, the whole arrangement should be assessed under the sale and leaseback guidance. US GAAP provides more detailed indicators for determining control in build-to-suit scenarios, but the principle is the same.
Okay, nearly there. Subleases, where a lessee leases the asset out to someone else.
Both define it the same way the original lessee becomes an intermediate lessor. They account for their original lease, the head lease, and the new sublease as two separate contracts.
How is the sublease classified?
Big difference here. IFRS requires the intermediate lessor to classify the sublease by reference to the right-of-use asset arising from the head lease.
Okay.
US GAAP requires classification by reference to the original underlying asset itself. This can definitely lead to different classifications, e.g. operating versus finance, for the same sublease under the two frameworks.
Wow, yeah, basing it on the ROU asset versus the original physical asset could really change things.
Yeah.
Finally, leases between related parties.
IFRS doesn't have much specific guidance. The general lease rules apply.
In US GAAP.
US GAAP says related party leases should be accounted for based on their legally enforceable terms and conditions. It explicitly disallows off-market adjustments in related party sale leasebacks.
Any practical help?
Yes, there's a practical expedient for private entities under common control. They can elect to use just the written terms, if any, to determine if a lease exists, its classification, and the accounting.
And anything else unique for related parties in US GAAP?
Yes, a specific requirement about leasehold improvements. If a lessee makes improvements to a related party lessor's property, those improvements must be amortized over their useful life to the common control group, regardless of the lease term, as long as the lessee controls the asset.
So potentially amortizing over a much longer period than the lease itself.
Could be, yes.
Phew. Okay, we have covered an incredible amount of ground today, navigating lease accounting under IFRS and US GAAP. It's clear there are agreements, but also some really crucial differences.
Absolutely. We saw agreement on the basic definition, but then divergence in scope and tangibles, those specific GAAP exclusions.
And the lessee counting. That single IFRS model versus the dual US GAAP model is huge.
Massive difference in subsequent accounting and P&L presentation. And the lesser classification too, GAAP's more rules-based tests versus IFRS's principles-based indicators, plus all those detailed differences in taxes, residual value guarantees, modifications.
Related parties, subleases, the list goes on.
It does. It highlights how two frameworks aiming for similar goals can arrive at quite different mechanics.
And for you, the learner, hopefully comparing that single versus dual lessee model really clarified things. And maybe seeing the different triggers for reassessing classification or the different practical expedients available like low value under IFRS but not GAAP gave you some useful takeaways.
Understanding these differences is just vital, isn't it? Especially if you're dealing with multinational companies or comparing financials or structuring transactions. Sale leasebacks and related party rules in particular have big practical consequences.
Definitely. So here's a final thought to leave you with. We see this constant push-pull with global standards convergence efforts, but also persistent differences driven by history or local needs. Thinking about lease accounting and the differences we've discussed.
Yeah.
Where might things go next? Will we see more alignment, perhaps driven by user demand for comparability, Or will these distinct approaches, like the dual model and GAAP, remain entrenched? What pressures might drive future changes in this area?
That's a great question to ponder. The standard setting process is always evolving.
Indeed.
Sure.
Hopefully this deep dive has given you a really solid foundation to understand the current landscape and maybe even anticipate some of those future shifts. Thanks for joining us on the deep dive.